Welcome to our halftime report presentation. We are delighted to see all of you here today and look forward to sharing some important information with you. I want to draw your attention to these disclosures. Please take a moment to review and let me know if you have any questions. One of our goals today is to review the first half of 2022. It would be impossible to cover everything that's happened this year, so we're going to take a closer look at some of the key developments that drove U.S. equity market performance in the first half. We're also going to examine the forces that may influence the markets in the second half of the year. Let's begin by reviewing how the stock market performed during the first half of 2022. Here is a snapshot of the S&P 500 index performance from December 31st, 2021 to May 31st, 2022. The S&P 500 Composite Index is an unmanaged index that is generally considered representative of the U.S. stock market. Index performance is not indicative of the past performance of a particular investment. Past performance does not guarantee future results, and individuals cannot invest directly in an index, and the return and principal value of stock prices will fluctuate as market conditions change. Shares, when sold, may be worth more or less than their original cost. The S&P 500 fell steadily throughout the course of the first 5 months of the year as economic growth cooled, inflation picked up, and the Fed began a pivot to a tighter monetary policy. As you can see from the milestones marked on the chart, investor enthusiasm was dampened in January as the consumer price index came in at 7%. Fed Chair Jerome Powell surprised markets later in the month with the talk of shrinking the Fed's balance sheet. And in late February, the market learned about the invasion of Russian troops into Ukraine. On March 16th, the Fed implemented its first rate hike. A short time later, we learned that inflation was hitting a 40-year high. The negative sentiment gathered momentum in April and May when the Fed raised rates again, this time by 50 basis points. Markets continued their struggles in June as recession fears grew, and May's CPI release showed inflation had reached a 40-year high. In response to this elevated inflation and rising inflation expectation, the Fed hiked interest rates by 75 basis points in mid-June. So we've talked a bit about how the S&P 500 performed so far this year, but how does that performance compare to expectations? It's a good question. At the end of the year, various media outlets compiled some Wall Street analyst predictions for the year ahead. This image shows several projections shared at the end of 2021. It's very interesting. How do those predictions compare to reality so far? From this previous slide, we can see that the S&P 500 closed on May 31st, 2022 at 4132. The S&P 500 closed at 4766 on December 31st, 2021, so the end of last year. The forecasts for 22 were very modest, as the table suggests. Even the most optimistic forecast in the table represents less than a 10% increase for the year. The outlook was reflective of expectations that economic growth would moderate, while interest rates would likely be heading higher. Predicting where the S&P 500 will be by the end of the year is always challenging, especially this year in 22, given the uncertainties of inflation, global economic growth, and rising interest rates. It's worth repeating that the S&P 500 Composite Index is an unmanaged index that is generally considered representative of the U.S. stock market. Index performance is not indicative of past performance of a particular investment. Past performance does not guarantee future results. Individuals cannot invest directly in an index, and the return and principal value of stock prices will fluctuate as market conditions change. Shares, when sold, may be worth more or less than their original cost. Now let's take a look at some economic and financial indicators to help understand how we got here. To put today's economy in perspective, let's look back to January 2012, when the US economy was in a fragile recovery. Though the US economy was officially out of recession, growth was slow as we continued to feel the effects of the 2008 credit crisis. Here, you see 20 speedometers representing 20 indicators. You can see that there is an equal number of green indicators as there are of the cautionary yellow indicators. 4 red indicators show that there still remained a fair amount of uncertainty over our economic health. Let's fast forward to January 2022. It's a different picture with 17 of 20 indicators reported. Strengthening or positive numbers and no negative indicators. Perhaps the most notable of the 3 neutral indicators is the equity market valuation dial. Nevertheless, the year began with an optimistic outlook for the economy and capital markets. By May, however, there was a more mixed outlook. While there's only one red indicator, geopolitical risk, there are fewer green indicators than just 4 months ago. In fact, 6 inputs moved from green in January to yellow in May, including monetary policy, yield curve, interest rates, international economic outlook, inflation, and energy costs. The indicators reflect a shift in the Fed's monetary policy, the continuing overhang from the pandemic, such as supply chain disruptions that have elevated inflationary pressures. Also, the war in Ukraine has unsettled overseas economies and driven energy prices higher, while China's zero COVID-19 policy has hurt its economic growth and exacerbated global supply chain issues. This chart shows the relationship between changes in the S&P 500 performance and the 12-month forward earnings per share, or EPS. As you can see, the 2 lines have generally moved in the same direction over the past decade. During 2020, the volatility in the stock prices and earnings was the result of COVID-19. As markets rebounded on the expectation of economic recovery, earnings rose, but not at the same rate as stock prices, creating a wider gap between prices and earnings. As you can see, this gap narrowed in 2022 as stock prices have come down and corporate earnings have grown. Here are a couple of reminders. First, past performance does not guarantee of future results. Over the next 10 years, the correlation between stock prices and corporate profits may look different. Second, individuals cannot invest directly in an index. And third, the return and principal value of stock prices will fluctuate as market conditions change. And again, shares, when sold, may be worth more or less than their original cost. At the highest level, the Federal Reserve has 3 functions: to provide an effective payment system for the U.S., to regulate banking operations, and to set monetary policy. When determining monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. As it works to uphold its monetary policy goal, one of the indicators monitored by the Fed is the overall level of prices, which helps it determine whether to adjust interest rates. The Fed has stated that it's comfortable with inflation in the 2% range. This line graph shows the consumer price index, or the CPI, and core CPI, which excludes food and energy prices over the past 50 years. Inflation became a principal worry for investors in 2022, since rising prices may hurt corporate profits, reduce the business investment necessary for future growth, and influence the spending capacity of consumers. As inflation has become more persistent than originally anticipated by the Fed, there is a growing anxiety that inflation could play a role in moving the economy toward a recession. The pace of inflation will also dictate Fed policy. Notice the PCE, personal consumption expenditure numbers, at the bottom of the box. This is the measure of inflation that the Fed watches most closely for making decisions on interest rates. Right now, it's above the Fed's 2% target, and though the Fed has said it's comfortable with overshooting its target for a brief period, although this elevated PCE may keep pressure on the Fed to raise rates in the months ahead. Everyone in this audience may have felt the impact of inflation. For some, it can be especially difficult to adjust to rising prices. The chart is instructive for a couple of reasons. First, it shows that various contributors to each month's year-over-year inflation rate. As the bar chart suggests, inflation has hit consumer wallets on nearly every level, from food and energy to eating out and new and used cars. The overhang for markets in 2022 has become whether inflation continues to rise or plateaus and comes down from here. Economists have pointed to a number of reasons for the emergence of inflation, including monetary policy, strong consumer demand during a period of supply chain problems, and fiscal stimulus that has helped create greater consumer demand. Let's take a moment to talk about wages and unemployment. This graph shows the unemployment rate and year-over-year wage growth for the past 50 years. Do you notice anything about how these two lines relate to one another? Most of the time, wages and unemployment have an inverse relationship. When one goes up, the other goes down. This historical correlation has been a bit murky in the post-pandemic period, which has witnessed a recovery in the labor market as the unemployment rate continued to decline in the first half of 2022, while wage growth has been strong. The growth news is that workers appear to have more opportunities to find employment and get paid a better wage. The bad news is the inflation rate has outpaced some of the wage gains. The University of Michigan Consumer Sentiment Index is one of the most widely used sources to help analysts understand how the average consumer feels about the economy. This index is valuable as it surveys at least 500 residents of the U.S. each month by phone. The survey uncovers consumers' opinions regarding their own finances as well as business conditions in the country. Understanding how people feel about the economy is essential because consumer spending accounts for more than 2/3 of the gross domestic product, also known as GDP. As the chart indicates, consumer confidence has been trending lower in 2022. That's understandable given the acceleration of inflation, the invasion of Ukraine, rising interest rates, and the supply chain issues. Economists will be watching how lower confidence influence consumer spending for the remainder of the year. As the world's second largest economy, China has a significant impact on the global economic activity in two distinct ways. Number one, as a consumer of products and services, and two, as a manufacturer of goods and services that are in demand worldwide. China experienced a COVID-19 outbreak in the first half of this year. Its zero COVID-19 policy led to complete and partial economic lockdowns throughout the country, but especially in important economic regions and cities such as Shanghai. In the first chart, you can see the rapid acceleration of COVID cases in Shanghai between April and May this year. The lockdowns shut factories and ports that make and ship essential goods in the global supply chain. As you can see in the second chart, the lockdowns have slowed manufacturing and other business activity in China, leading to a slowdown in their economy that investors fear may influence Western economies. Also, China's actions hurt already fragile global supply chains, impacting American businesses and consumers in the form of product shortages, delivery delays, and higher prices. The most devastating consequence of Russia's invasion of Ukraine is the human toll in lost lives, destroyed communities, and decimated economy. As you may have heard, many countries, including most of the world's largest economies, responded to the invasion with economic sanctions against Russia. Russia has been a major exporter of energy, metals, and wheat. These sanctions have led to sharp increases in the prices of oil, natural gas, some metals, and certain food items. The invasion has limited the ability of Ukraine, a major wheat exporter, to produce and export this commodity. The global supply chains in turn have been stressed as European countries have been forced to find new suppliers for their energy needs, and manufacturers have struggled to replace their sources of base metals. The net effect of it has been general lowering of economic growth projections globally. Finally, there are longer-term implications around what the impact will be on the world economic order of the post-World War II period. For instance, we already see a move to reshore critically important manufacturing, like semiconductors, as policymakers and business leaders ponder a future scenario in which China might invade Taiwan, a key producer of semiconductors. Before we move on to our outlook for the second half of 2022, let's take a moment to consider the variables that could upend such forecasts. We believe that the factors that led to the first half's market downturn may remain critical to how the market may behave in the second half. The first factor is inflation. The big question mark is whether inflation has peaked or will continue to accelerate. In any case, the Fed may likely remain quite hawkish as it seeks to move monetary policy ahead of the inflation curve. The Fed has signaled a 50 basis point increase is possible at its future FOMC meetings. The question is whether inflation conditions require them to become more aggressive with rate hikes later on this year. Another risk is bond yields. As the Fed raises short-term rates, bond yields along the yield curve are likely to trend higher. Higher interest rates may have substantial impact on economic growth as it becomes more expensive to borrow money. The other implication for stocks is that higher bond yields may suddenly make bonds more attractive, providing investors with an alternative to stocks that may not have existed for them when rates were near zero. Corporate profits also loom as a potential risk to stocks. In the first half of 22, the market punished many stocks when companies fell short of sales and earnings estimates. During anxious markets, investors may be more focused on corporate earnings as evidence that current valuations are fair. Consequently, corporate America might need to deliver on profits if market sentiment is to improve. Finally, there is always the so-called black swan event, something no one expected, like a pandemic. Of course, no one can predict what will happen in the future, but we hope the following perspectives help you understand what we believe may be on the horizon. Now, let's dive into forecasts for the second half of the year. The sharp post-pandemic economic recovery is firmly in the rear view mirror. As you can see in the chart, the Federal Reserve projects that the economy will veer toward more historical norms of economic expansion in 2022, 2023, and 2024. Of course, positive or negative surprises on GDP growth in the second half may influence financial markets. In part, corporate earnings are reliant on the pace of overall growth in our economy. Remember, forecasts are based on assumptions and subject to revisions over time. Financial, economic, political, and regulatory issues may cause the actual results to differ from the expectations expressed in the forecasts. Some market strategists look at the bottom-up earnings per share to help set their price target for the S&P 500 index. When setting a bottom-up EPS, market strategists focus their attention on estimating earnings for all S&P 500 companies. By contrast, top-down investing target price places a greater emphasis on macroeconomic factors when making an investment forecast. The chart shows the bottom-up EPS and the price of the S&P 500. A word of caution when you read this type of analysis: it shouldn't be seen as a flawless predictor of future stock price performance. That said, note how stock prices got ahead of corporate earnings, leading to more expensive valuations. As the market corrected over the first 5 months of 2022, you can see price levels now have dipped below their projected earnings lines. Inflation fears have weighed on the stock market. This slide shows what market participants expect inflation to be over the next 10 years. As you can see, these expectations rose throughout 2021, but have moderated a bit in 2022. The intersection of economic growth and inflation will likely be critical to investors, since one emerging concern is the idea of stagflation. Stagflation is an economic environment characterized by slow growth, faltering demand, and rising unemployment. The Fed is pursuing a more aggressive monetary policy to combat today's high inflation, which is why the remaining FOMC meetings are so important to the markets. The forecast for the 10-year break-even inflation rate is based on the assumptions and subject to reviews over time. Financial, economic, political, and regulatory issues may cause the actual results to differ from expectations expressed in the forecast. So what's ahead for short-term rates? So investors' inflation concerns may mean that Wall Street keeps an eye on the Federal Reserve's scheduled meetings in the coming months. Investors will be listening closely to the announcements coming from these meetings to gain insight on how aggressive the Fed will become with future rate hikes and balance sheet reduction steps. So what could be ahead? The Federal Reserve's Open Market Committee is scheduled to meet 4 more times in 2022. As you can see here, July 26th and 27th, September 20th and 21st, November 1st through November 2nd, and December 13th and 14th. Typically, if the Fed's going to make an adjustment to interest rates, it'll announce the change following their 2-day meetings. Here's another relationship to understand. Bond prices and bond yields have an inverse relationship. In other words, when bond yields go up, bond prices go down. After experiencing years of low interest rates, some investors may be surprised to realize their bonds can lose money if sold before they reach maturity. Bond values may decline during periods of rising interest rates, but a changing tide in the economy doesn't mean you have to abandon a fixed income. Often, this movement is an important part of a well-balanced, diversified portfolio that may provide investors with the income they need. However, keep in mind there's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification is an approach to help manage investment risk. It does not eliminate the risk of loss if the security prices decline. Tuning out headline noise while managing your finances is not always easy. However, wise investing involves more than just reacting to headlines that may discuss consumer sentiment or geopolitical developments. For investing opportunities, one approach is to stay focused on fundamentals like the company's earnings or economic data. We've gone over a lot today, and if you remember just one detail from today's presentation, we hope that it's this. Emotions have no place in investing. Market corrections are a normal part of market cycles. The first half of this year is a great reminder. This chart is one of my favorite charts. This chart shows the intra-year lows each year going back to 1980 in yellow, with annual returns shown in gray. As the chart illustrates, there have been many years that saw declines intra-year. Volatility can be uncomfortable, but it is normal. Managing your expectations during good times is just as important. Ultimately, taking a long-term view of the markets is essential when pursuing your long-term goals. If you ever feel concerned or want to understand what's happening, lean on us for support. We're here for you, and we want to help you make the most of your financial life. Remember, past performance does not guarantee future results. Individuals cannot invest directly in an index. The return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than their original cost. This slide shows why it's important to tune out the noise and focus on your time horizon, risk tolerance, and goals. If we look at the market since 2006, we can see the danger of missing some of the best days in the market. As the chart illustrates, a $10,000 investment on January 2nd, 2006 would have increased to more than $45,000 by the end of 2021. Had an investor been out of the market and missed just 10 of the best days during this period, that investment would be worth $20,929. If an investor missed 20 of the best days, that investment would be worth $12,671. Miss 30 or more of the best days, and an investor would have lost money. Investors who sell stocks in response to difficult market conditions often miss those all-important best days. The S&P 500 Composite Index is an unmanaged index that is generally considered representative of the U.S. stock market. Index performance is not indicative of the past. Past performance does not guarantee future results, and you can't invest directly in an index, and they do fluctuate in value and may be worth more or less than your original value. We've gone through a lot of information here, and I'm sure many of you still have lingering questions. Remember, if you're wondering something, it's more than likely that someone else out there has that same question. So feel free to reach out to me at 317-399-1107 or email me at bfoster@northboundwealth.com, and I would be happy to respond to you or set up a meeting to talk. Thanks so much for your time today. As you can tell, I'm passionate about helping you understand the markets. For more information and timely updates, please follow us on social media and contact us anytime. I would be happy to answer questions. We hope that you enjoyed the details we shared with you today. Have a great rest of your week, and we'll talk to you soon. Thank you.